Hello everyone, in this video we are going to learn about the ratio analysis. This particular series will focus on the theoretical aspect as well as discussion of various formulas to calculate the various ratios, and this series will cover in 3 or 4 parts, and as it is very lengthy if I'll cover all those formulas in just one video. So I'll try to make 3 or 4 videos so that it would be easier for you to understand all those formulas. So let us start. So what is ratio analysis? So ratio analysis is a method or process by which the relationship of items or group of items in a financial statement are computed and are presented. Okay, and it is an important tool of financial analysis, and it is used to interpret the financial statement so that the strength or the weakness of a firm, its historical performance and the current financial position can be determined. Coming up, it is a mathematical yardstick that measures the relationship between two figures or group of figures which are related to each other and are mutually interdependent. It can be expressed as a pure ratio, percentage, or as a rate. So we can express our ratio in a pure ratio form, that is 2 is to 1, 4 is to 1, 3 is to 1. Otherwise, we can use the percentage like 30%, 40%, 60%, or we can use it as a rate like 6 times, 5 times, 8 times to express the ratio. Okay, so what are the utilities of ratio? So accounting ratios are very useful in assessing the financial position and the profitability of an enterprise. However, its utility lies in the comparison of the ratio analysis. uh, Later on we will discuss on it, and apart from that, there are so many utilities, and the comparison part will be focusing on the for the same enterprise over a number of years, and for two enterprises in the same industry, for one enterprise against the industry as a whole, for one enterprise against the predetermined standard, and lastly for inter-segment comparison with the same organization. Okay, so let us start with the classification of ratios. I'm not going to give a proper definition or discussing the in depth, but just I'm revising the whole ratio analysis chapter, so it would be better for you. So let us start with the classification of ratios. So ratio can be broadly classified into the 4 categories. The first one is liquidity ratio. The second one is capital structure or the leverage ratio. The third one is a profitability ratio, and the fourth one is activity ratio. So in this video we will just discuss on the liquidity ratio, and later on we will discuss all three in a different parts of this video series. Okay, so let us start with the liquidity ratio. So this ratio analyzes the short-term financial position of a firm and indicates the ability of the firm to meet its short-term commitment, that is the current liability, out of its short-term resources, that is the current asset. So this ratio is also known as solvency ratio, and it includes the calculation of current ratio as well as the liquidity ratio. For your better understanding, I would like to indicate one thing. The another name of liquidity ratio is quick ratio and acid test ratio, and there is one more ratio that is also calculated in the liquidity ratio section, that is absolute liquidity ratio. But these are the two most important and famous ratio that are used to calculate the liquidity of the firm, that is current ratio and liquid ratio. Now, what is meant by the liquidity? That means how efficiently or how the company is able to pay its debt, and how it is managing its current liability, current assets over using the its current liability, or how fast the company is paying the current liability using the current assets. Okay, this is what the liability is. So liquidity in this liquidity ratio section we are dealing with the two ratios, that are current ratio as well as the liquidity ratio. So let us see one by one. And the current ratio, so it is calculated by dividing the current asset by the current liabilities, that is current ratio is equals to current asset divided by current liability. And conventionally a current ratio of 2:1 is considered satisfactory. What does it mean? It means that if a company has a current ratio of 2:1, that means it is performing well. Let's say if a company has a current liability of rupees 10,000, whereas its current asset is 20,000. Okay, that means the ratio is 2:1. That means company is performing well. While on the other hand, if a company have a uh, current liability of 10,000 rupees, whereas the current assets are only 15,000, that means the current ratio will be 1.5:1. That means the company is performing less than the satisfactory benchmark. Okay, so just remember one thing, the benchmark for the current ratio is 2:1. Okay, now I hope you know what is current asset and current liability, but I have mentioned the items which are included in the current asset. You can go through this, and as well as what are the items that are included in current liabilities. Okay, so let us come to the second ratio, that is our quick ratio, acid test ratio, or liquidity ratio. Okay, so this is a ratio between quick current asset, or that is also known as quick asset, and the current liability, and sometimes we also use the quick liability as well as. So it is calculated by dividing the quick asset divided by quick liability, or sometimes current liability, and conventionally a quick ratio of 1:1 is considered to be satisfactory. Now there is a one question, that what is quick asset and what is quick liability. So we are going to discuss. Before that, let us assume a company has a quick asset of rupees 1 lakh, and while the quick liability is also 1 lakh. That means the company has a quick ratio of 1:1. That means it is fulfilling its requirement and it is satisfactory. While if the quick liabilities are 1 lakh, but the quick asset are 50,000 only, then the ratio would be 0.5:1. That means the company has to look into it, and uh, it has to increase its quick asset to perform well. While if the quick liabilities will be higher than the quick asset, then it need to be look into it performance. And while if the ratio would be 2:1 or 3:1, then there are so many idle current assets that are not performing well, so company again need to look into it. Okay, so let us understand what is quick asset and what is quick liability. So quick asset means all the current assets minus prepaid expenses and inventories. So these are the two items that should be deducted from the current assets, that is total current asset, to get the quick asset. So this is just easy, just add all the current asset and deduct the prepaid expenses and the inventories. So that comes up to the quick asset. While the quick liability, add all the current liabilities and just deduct the bank overdraft and the income received in advances. So in most of the problem you will just find bank overdraft. So if somewhere you find the total, let's say the current asset is 1 lakh, and prepaid expenses is 10,000 and inventory is 5,000. So 1 lakh minus 10,000 minus 5,000, that comes up to 85,000. So your quick asset would be 85,000. In the similar case, if your quick liabilities are 1 lakh and the bank overdraft is 5,000, so 1 lakh minus 5,000, that comes up to 95,000. That is your quick liability. I hope it is clear. So you just need to remember two things, that is from the total current asset we need to deduct the prepaid expenses and inventories to get the quick asset, while we need to deduct the bank overdraft from the total current liabilities to get the quick liabilities. Okay, so this is it for this particular part, and thank you so much and keep it up. So we will cover all those left out formulas in the separate videos. So keep watching. Thank you so much. Bye bye.